ESG space, all the criticism and backlash, he thinks it's good.
He thinks it's good because he says it's given a lot of airtime. Like a year ago, who was talking about ESG? Maybe us, or, Wall Streeters, but people.
The market was rallying. We didn't care about anything. No, it's like crazy, right? No, sorry, we do always care.
But Main Street never weren't talking about it, and he was just saying, look, we need that. It's just to get the debate out. Force a debate, because it's not perfect.
Right.
So, that's why he's just like, hey, this is all good. If it's being bashed by the Republicans, so be it.
So where does it leave sort of the conversation about ESG right now? Because, as Carol mentioned, it's gotten a really, we used to talk about it a lot in terms of,
all the time.
Right, in terms of it being a sort of a net positive.
Mm-hmm.
But now it's just getting beat up left and right. So is it something that is still taken seriously by the investment community?
Oh, yeah, no, it is. I mean, look, we did Bloomberg did a survey of terminal readers loss in the last couple of weeks, and the survey found that, people are saying ESG is going to be here to stay. So I think it's just having this branding problem more than anything. That said...
Although the EU has been pretty tough about the ESG space, and there's a great story out there today about BlackRock, PIMCO, Amundi are among firms that have already said they're removing the EU's highest environmental, social, and governance fund designation from large chunks of their business. So there's been a shift already.
Absolutely. I mean, they're way ahead on all of these initiatives. But here in the US, a number of states are going to be introducing anti-ESG bills next year, whether they pass or not. Congressional hearings with the newly empowered Republican House.
So anti-ESG meaning what? We don't want to invest in the ESG space?
These just like
what does that mean?
Anti-Blackstone bills to a certain extent?
What does it mean?
BlackRock, to an extent.
BlackRock, excuse me, yeah.
They just don't want Wall Street firms using ESG metrics. So if you are, BlackRock has been a big proponent. They're like, we don't want to do business, which is what we saw last week with Ron DeSantis pulling a couple of $1 billion from BlackRock, which BlackRock manages, $8 trillion. It's nothing, but it hasn't been inconsequential because, you've got Larry Fink, who said he's been spending a lot of time going down to D.C. trying to correct the narrative.
Or maybe correct the space rather than the narrative. Just saying. Sejal, thank you so much. Really timely topic, certainly. Sejal Kishan, ESG reporter at Bloomberg News. Check out her story. You can find it on the Bloomberg terminal, among the most read on the Bloomberg. And, of course, you can head to Bloomberg.com for more.
We're off of session lows on the S&P 500, Carol.
Yeah.
It's still down 1.9%. The NASDAQ taking the brunt of it. Of the three major indices we follow, down more than 2%. The Dow down 1.5%. Taking a look at the Russell 2000, which earlier was down more than 2%. We're seeing it down 3% as we speak.
Yeah, and what's interesting, if you take a look at the S&P 500, 472 names are lower in the session, 30 higher, 1 unchanged, so almost broad-based selling here.
Let's get to Washington, D.C. now for World and National News. In our 991 studio is Nancy Lyons. Hey, Nance.
Thanks, Tim. Lawmakers have a week and a half to fund the government, and they're still trying to hammer out a basic framework for top-line numbers.
Lawmakers are now looking at a stopgap measure to help buy some time, pushing the deadline closer to Christmas. Some Republicans are ready to sign off on a full-year stopgap because that would freeze spending. But Republican Richard Shelby says that would also hurt the military. Plus, appropriators warn a full-year stopgap measure would undermine national security. House Minority Leader Kevin McCarthy says Republicans would support a stopgap into January, but Shelby says it's important they do their job while they're there. In Washington, I'm Amy Morris, Bloomberg Radio.
Republicans are still facing questions about former President Trump's call to suspend the Constitution to overturn his loss in 2020. Senator Bill Cassidy tells Bloomberg this may be a Hail Mary from a former president whose candidates fared badly in the midterms.
I see people who are strong supporters of the former president, and they say we're about winning. And so if we're going to be about winning, we've got to do something different. I think the more that kind of is understood in our party, the Republican Party wants to win. And we've got to make those changes required to do that. So I think that'll have an impact.
Louisiana's Bill Cassidy is one of the Republicans who voted to impeach former President Trump after January 6th. Well, it is the final day of campaigning in Georgia's Senate runoff, with incumbent Senator Raphael Warnock facing off with Republican Herschel Walker. A win by Warnock would push the Democratic majority in the Senate to 51. And all-star pitcher Justin Verlander has signed on with the Mets. That deal worth $86 million. At the World Cup, Croatia beat Japan in a match that went to penalty kicks. Brazil is easily winning against South Korea. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got the Dow, the S&P, NASDAQ very much in the red. 20 minutes to go ahead of the closing bell right now with the S&P down by 80 points. That is a drop of 2%. Again, very close to session lows. Dow Industrials down 530 points, a drop right now of 1.5%. NASDAQ down 251. That is a drop of 2.2%. 10-year yield 3.59%, with the 2-year yielding 4.40%. Gold down $30 the ounce to $17.67, a drop there of 1.6%. West Texas Intermediate crude down 3.4%, $77.23 a barrel. Julie Beal is portfolio manager at Kane Anderson Rudnick Invest. She told us she remains focused on the consumer.
I think looking forward, it's more important to understand that where consumer demand is and the strength of the consumer overall. We're seeing them come back into their credit cards. They've spent down a lot of their savings. We need a strong consumer really in order for this economy to work. So if there's any hint of that, I think the bear market returns in a meaningful way.
And speaking of the consumer, VF Corp, that is the owner of Vans sneakers and the Supreme streetwear brand, has cut its forecast on weaker than expected demand in North America. Shares of VF Corp right now down 11.1%. Briefly, Hertz Global Holdings will spend $168 million to settle hundreds of claims that it falsely reported rental customers to the police for car theft when a vehicle was not returned on time. Hertz shares down now by 3.4%. Recapping, S&P down 2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, folks, we're just about 18 minutes away from that closing bell. Charlie, walking through those numbers. We're down across the board, broad-based selling, as you heard, but we're coming off our lows of this session. But nonetheless, risk-off trade today, Tim.
Eager to hear what our next guest has to think of it. Rick Pitcairn is the Chief Investment Officer of Pitcairn Family Office. They've got $7 billion in assets under management. Rick joining us via Zoom from Pennsylvania. Rick, how are you?
I'm good today. How are you?
They're doing pretty well. Markets are not doing so well today. It's kind of interesting to see this reaction to the economic data that we got earlier today. Given the context of what we heard last week from Fed Chair Jay Powell, how are you thinking about where we are right now?
I think we're just in the midst of a real change in the philosophy of the Fed. It's been going on for a year, and I think that investors are, in fits and starts coming to terms with the fact that we're going to be in a tighter money environment for a while and what that means about their investments.
So what does it mean about their investments at this point? Do you think valuations, certainly on the equity side of things, are still too high, Rick?
Well, I think that there's a ways to go down. I think there's still another foot to fall, depending on how the data sorts out. But however the data sorts out, whether inflation comes under control a little bit more quickly or takes a little bit more longer for the Fed to bring that under control, I think the Fed's going to stay tight. They've got to unwind that balance sheet. They've got to do some things. We have to do some things as a society that get us away from that COVID environment, and that means tighter money to me. And, how investors should think about that is not to run and hide. I mean, I think the original reaction is, well, if it's tighter money environment, that's bad for all risk assets. I wouldn't say it's bad for risk assets. I'd say it's different for risk assets. And, the wise investors will understand how portfolios may work a little differently in the next 3 to 5 years as they did in the last 3 to 5 years.
Well, let's talk about what that sort of a tighter money environment means, Rick. Are you talking about an environment that we saw in the 1990s, in the 1980s, or do we ever go back to what we saw post-Great Financial Crisis with rates pretty much at zero?
No, I think more like 70s, 80s. I mean, I don't think these environments ever exactly replicate each other. They're more like they rhyme. But, when I was younger in this business, and I've been around for a while, we used to talk a lot about quality stocks versus not low quality stocks, and we meant stocks that have stronger balance sheets and stronger cash flows. And as we got into this zero interest rate environment, I think a lot of that analysis went out the window, and it was all about growth and all about that top line story. I think we may revert back to looking at the sort of the stronger metrics of financial strength, because I don't think it's going to be so easy just to go to the capital markets and get the money you need to grow.
Yeah, it's interesting because it's been fairly easy. In terms of the recession that people seem to think that we will likely see in 2023, how are you thinking about it and how it impacts strategy maybe for some of the family offices that you guys work with?
Well, I think that it's always a scary thing, right? And we don't know how deep this recession might be. I don't even think the Fed knows. I think the Fed has a preference for, controlling inflation by whatever means they have to get that under control. And if that means a recession, in their minds, they would hope it would be shallow and short. Detractors of the Fed would say they're actually tightening into this slowing economy, and it's going to be much deeper and longer than they think. We're very fortunate at Pitcairn. We have clients that, by and large, have very long-term time horizons. They're very much more strategic than they are tactical. So it's interesting to think of these things as something to be taken advantage of rather than something to run from. So it's more of a long-term investing mindset. And how do we come out of this in the posturing that we want to be? And that's helpful, because I think investors that think they can step out of this at exactly the right time and step around all the bad that markets have to hand us during a recessionary period really can't execute up to that ideal.
Huh. But Rick, what about stepping in at the right time? Because if you have money to deploy right now, when would be the right time to invest it?
Well, I think you should be thinking about that now, because we don't know. I mean, I would advocate systematic drops of that money into the market over the next 6 months or 4 quarters, and that's a more academic way to approach it than say I'm going to invest it all exactly when the timing is right. But I find that's pretty hard to execute on, really. If I see a lot of people that want to do that, I don't see a lot of people that succeed doing that. So if you've got cash on the sidelines for whatever reason, I'd advocate, we're already down 20. We may have more to go, but these markets, the downturns in capital markets, this one's been going on for about a year now. On average, they don't last much longer than that. Now we have a lot of bricks in the wall of worry that make us think it's going to go deep into 23 and maybe into 24. But if you have a longer term view, I think I'd be more willing to take an academic approach and systematically begin to take advantage of where we are.
You do work with family offices, as you said. You reminded us, Rick, that they have long-term horizons, right? So some of the volatility is not necessarily something that they're so worried about. They're also in a very diverse set of asset classes and often alternative investments. So you mentioned, though, maybe is it for a retail investor that some of the beaten down names is an opportunity? Is there any names or areas in particular on the equity side of things that you would suggest?
Well, we generally hire managers that go ahead and take advantage of these markets. So I'm going to stay away from names. But here's what I'd say is, if you're a retail investor, try not to invest with the mindset that the real tech go environment that we had in 2019, 2020, 2021, I think a lot of people think that's going to come right back. You look at flows into ARC or flows into the QQQ, they've been strong up until recently. And you look at flows into energy, even though energy's up 35%, they're not all that great. I would think that I wouldn't hang out at the scene of the car wreck, if you understand what I'm saying. That all this tech stuff looks so weak, but I think it's going to take longer for that kind of stuff to come back.
All right, we're going to run. Rick, thanks so much. Rick Pitcairn, he is CIO at Pitcairn Family Office, joining us via Zoom in Pennsylvania. You're listening and watching Bloomberg Business Week. Carol Massar, Tim Stenovic. This is Bloomberg Radio.
I'm Charlie Pellet from Bloomberg World Headquarters with a roundup of the day's top business stories. Tesla shares are trading lower after Bloomberg News reported the electric vehicle maker plans to lower production at its Shanghai factory. Right now, we have got Tesla trading lower. Tesla shares down by 6.6%. Elon Musk, meanwhile, says Apple has fully resumed advertising on Twitter, further de-escalating a brewing war between two of the world's most influential technology companies. Speaking of influential tech companies, Stuart Butterfield, CEO of Salesforce's Slack, is leaving the company, another blow to the software giant that has seen an exodus of executives recently. Butterfield's departure follows the announcement last week that Salesforce co-CEO Brett Taylor would be leaving the company at the end of next month. Right now, Salesforce.com shares are trading lower, down now by 7.3%. Delta Airlines pilots will be getting at least 31% in pay hikes over the 4-year term of an agreement in principle reached with the carrier. The Airline Pilots Association says the tentative accord with $7.8 billion in total increased value will also provide a one-time payment to pilots. Right now, we've got airline shares for the most part trading higher. Shares of Delta up 0.2%, UAL up 2.4%, American up by 1%, but on the minus side, Southwest down now by 0.6%, JetBlue up by 0.8%. Those are some of our top business stories. I'm Charlie Pellet.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, everybody. Carol and Tim here in our Bloomberg Interactive Broker studio, streaming on YouTube and on Bloomberg Quick Take. In just a few minutes, we're going to head over to our TV colleagues for Beyond the Bell, our cross-platform coverage, talk about the market trade. And, you know, sometimes we're looking for direction, a lot of volatility, but despite some optimism at the open, or at least based on futures trade this morning, it's been really a downward risk-off trade for almost all the day, or for all of the day, really.
We did see the S&P 500 down as much as more than 2% earlier, but it's come off of its lows, Carol, down 1.8. We're seeing the NASDAQ down more than 2%. And then a quick check of the Russell 2000, which, you know, at last check was lower by more than 3%, is coming up right now at down 2.9%.
Those small caps really getting clobbered, which, you know, many would say if you're worried about recession in the United States, those are some of the names that are going to be most exposed, right? The domestic plays, which can be insulated when you think the U.S. economy is going to be doing better than the rest of the world. So we like to keep a watch. In the meantime, deals are being done. And I find this interesting in the real estate space and the office space. We're going to talk about residential Manhattan a little bit later on Bloomberg Business Week. In the meantime, a couple of stories by Natalie Wong of Bloomberg News. One has to do with a Blackstone business, which has agreed to buy 6 industrial properties in the Toronto area. Blackstone Real Estate paying more than $270 million in cash for the properties. It's about 1.5 million square feet. They are fully leased. The transaction, one of the largest trades of a private industrial portfolio in Canada in recent years. And we're talking about warehouse, which is something that has been a big thematic play for Blackstone for a long time.
Here's what Janice Lynn, Blackstone's head of Canada Real Estate, said in a quote, "Global logistics is one of our highest conviction investment themes, and high-quality last-mile industrial properties like these continue to benefit from some of the strongest real estate fundamentals in Canada."
Yeah, they've been doing this for a long time, so maybe seeing some opportunity. In the meantime, another story by Natalie Wong talks about New York developer Silverstein Properties seeking to raise $1.5 billion for converting older offices to residential buildings. The landlord, known for developing towers at the World Trade Center, in talks with investors to kickstart what could be a $10 billion plus opportunity. The CEO, Marty Berger, saying in an interview, the firm exploring acquisitions of Manhattan office buildings that are facing growing vacancies or debt burdens. The effort could potentially expand to other areas of the U.S., such as Washington, D.C., Boston, and the West Coast. But this is, we talked about Midtown, office properties, nothing happening. Could you make it residential?
It's tough to do, though. I mean, you got windows that don't open. You got bathrooms that are communal right now. It's tough to do this.
All right, you are listening and watching Bloomberg Business Week.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld. We're counting you down to the closing bell, and here to help take us Beyond the Bell. It's our global simulcast with Carol Masser and Tim Stenevik. Welcome to our audiences across Bloomberg Television, radio, as well as on YouTube. And quick take, Carol. An S&P down about 1.7%. NASDAQ composite down about 2%, and the Russell now down almost 3%.
Yeah, really no place to hide in this market environment. What's interesting is the worst performing major industry group in the S&P 500, there are 11. At the bottom of the pack, energy, which we know has continued to outperform, still outperforming for the year, but nonetheless, investors even running from that space. We know there's geopolitical reasons why, among other factors, concerns about over in Europe in terms of energy supplies. That group, though, down almost 3%, Tim.
We just spoke to Rick Pitcairn, Chief Investment Officer at the Pitcairn Family Office, who said that this is an opportunity over the next 6 months that if you got cash on the sidelines and you've got a long-term time horizon to get in there. He said, not broadly speaking, though, he did say to avoid those high-flying tech companies that really excelled in 2019, 2020, 2021. He said it's going to take longer for those types of companies to recover in a higher rate environment.
Well, we were just talking to Lori Heinl over at State Street Global Advisors. She's still overweight cash. I thought that was such an interesting conversation. It's coming out of the fixed income portion of the portfolio, though, Romaine, not necessarily from equities.
Yeah, and I think that really gets to the idea here that while there are bargains to be found, a lot of people do think we're into a recession next year, we're in for a prolonged economic downturn. So is it too early, I guess, to deploy that cash? I guess it depends on what you're investing in and who your clients are. As for today here, we'll walk you through the numbers really quickly here. A Dow Jones Industrial Average going to finish the day down by about 1.4%. The NASDAQ down almost 2%. We'll call it about 1.9 as we wait for these numbers to settle. A broad-based sell-off in the S&P 500, though, with only about 30 stocks in the green, the rest in the red, down about 73 points or 1.8% here on the day. And the biggest laggard of the day, at least among the major indices, that belongs to the Russell 2000, Carol, down about 2.8%.
Those small caps taking a beating as well. If you look at the S&P 500, 472 names to the downside. Take a look at the NASDAQ 100, Katie, and you had 97 names losing ground. So again, speaks to investors really selling out of almost just about everything today.
Well, I don't have any better news when we look at the industry groups. It is all red. I dressed accordingly. All 24 groups lower right now. At the bottom, you have autos. A lot of that is Tesla, that big fall that we saw there. Up at the top, it's utilities being the least bad. I'm not sure how to phrase that. But in any case, utilities still off by about 0.6%, Carol, just broad-based selling.
All right, so let's get to some of the gainers. I did find some.
You
Cross
found
my
some?
fingers. Yeah, I did, and they actually held on to their gains. So MGM Resorts International was up more than 4% at its highs today, finishing the day just shy of a 2% gain, but nonetheless among your top gainers in the S&P 500. Truist upgrading the casino operator to buy from hold, and amid renewed optimism on China reopening, and that's why you saw this name moving higher. Keep in mind, last week we did get some headline news out of Macau, and 2022 gaming revenue on track to be the lowest on record, but I think perhaps maybe the worst is over as maybe we see some easing on those COVID-0 policies in China. So MGM certainly a standout. Take a look at the NASDAQ 100 today, and you had a lot of Chinese names that trade in the U.S., those ADRs. They were the top gainers in the NASDAQ 100. Among them, Baidu, that was number one in the NASDAQ 100, up 2.7% in today's session. Again, goes to those expectations. We're seeing more signs of those easing of the COVID-0 strategy in China. Major cities, including Shanghai and Hangzhou, easing restrictions. So again, some optimism about specific Chinese names. And then we had one, a biotech company. It's kind of a small cap. It's about a $1.3 billion market cap biotech company, soaring 17%, up as much as 23% at its highs, but finishing the day with a 17% gain. This after a board member bought $65 million worth of the company's shares. That happened on Friday. We got the filing. It's still about 12% of the float is shorted, and it's still down more than almost 60% year to date.
Well, 473 names lower in the S&P 500, Carol. I had a much easier job finding decliners today. We got to start with Tesla, Romaine. Finished the day down by more than 6.3%. Shares dropping the most in 2 weeks. This after a Bloomberg report that the company plans to lower production at its Shanghai factory. This is the latest sign that demand in China is not meeting expectations. We should note that a Tesla rep in China declined to comment, but Shanghai Securities News reported that the planned cut of the Chinese plant's production is, quote, false information. They cited unidentified people familiar with the company. And then Salesforce continues to see an exodus of the top names, top executives there. The latest among them, Stuart Butterfield, who has been at the company for less than 2 years. He was the founder and CEO of Slack. back. He's exiting the company, he said today. Salesforce finishing that down by 7.3%. We did see two other veteran Slack execs also leaving the company as well. And you'll remember last week, after the company reported results, we saw Brett Taylor, the co-CEO, say he'd step down at the end of January as the co-CEO of the company. Yeah. And then VF Corporation, down more than 11%, the biggest decliner in the S&P 500 on a percentage basis. This is a company that owns Vans, Supreme, the North Face, Timberland, and more, falling the most in more than 2 years after cutting its forecast on weaker demand in North America, also announcing the retirement of the chairman and chief executive officer, Steve Rendell-Romain.
All right, a lot of activity right now actually going on in the debt market. On the back of that hot ISM services reports here, you're looking at pretty significant drops in yields that we saw, jumps in yields, I should say. The 2-year yield up about 13 basis points on the day, the 5-year and the belly up about 15 basis points as well, your 10-year up about 10. And we should point out that some of the inversions that we're seeing on some of the key parts of the curve are pretty significant here to note. A 2-10s curve now at negative 81, so that's back down to the lowest levels that we've seen going back to 81. And if you take a look at the 5s 30 and the 2s 30s, the 2s 30s curve, that's now back down to its lowest level on record.
I want to talk about the 2s 10s. I'm dying to talk about it. Yeah, it's 81 basis points of inversion. I was listening, BMO.
I just said that, yeah.
I know, but BMO has this great podcast. It's called Macro Horizons.
Okay.
They're sticking to their call that the 2s 10s curve is going to reach 100 basis points of inversion, which seems really dramatic. I mean, that has to be a record in all time, but that's going to come from the 2-year yield getting to 450, 10 staying around where they are, around 350 or so. Big call.
All right, so I want to get to some headlines crossing the Bloomberg terminal. This is coming from the FTC investigating crypto firms over misleading advertising. The Consumer Protection Agency says probing possible misconduct. FTC confirming the inquiry into crypto marketing in a statement, so putting it out. No surprise, Tim, considering the headlines, the stories, the reality of what we've seen over the last couple of weeks with the collapse of FTX and Sam Bankman-Fried.
Yeah, but I mean, the question is to what extent can the FTC actually work on companies or find companies or have control over companies or admonish companies that aren't here based in the United States. So, that's a big question to consider when thinking about this in the context of what we've seen with FTX International, which of course is the backdrop here.
Well, I mean, but this is the CFPB, so we're talking about the actual marketing of it. So, I mean, any U.S. investor who is touched by this, gives them, to a certain degree, authority to go after this. I mean, we'll see if it means anything. I don't know who you go after. Do you go after SBF? Do you go after, Tom Brady? Do you go after, Larry David? Who do you go after?
Hopefully not Larry David. I mean, on a personal level.
He is lovable.
You're waiting for season 12 of Curb? Is that your excitement?
That would actually give him a lot of fodder for the next Curb Your Enthusiasm, right?
It would be like a whole season, right?
I think so.
That would be pretty good. But that gets back to this, again, alphabet soup of who actually regulates crypto here. And if they miss the ball, are we going to see more of these sort of enforcement actions come out of, these scattered investigations? It's going to be pretty busy couple of years, I would imagine.
Well, who owns it, right, ultimately? And I think this speaks to also, what is it, right? We often talk about this when we're talking about crypto as a basket, like we're just throwing this all together. But you know what I mean? Like, we're still having these questions about what is it? Is it a currency? Is it a collectible? What exactly is it? Then who has ultimately the oversight?
Well, but that raises the issue, too, of whether that even matters. Because I think at the end of the day, if you're marketing something, if you're trying to sell a product, whatever the use case is, if you're doing it in a way that is dishonest, and I put that in quotation marks, or in some ways maybe fraudulent in certain respects, then it's kind of moot what your intent was.
Well, the rebuttal from the Bitcoin maximalists, the maxis on Twitter would be, this isn't Bitcoin's problem. This is the fact that you have all of these companies that were created around this ecosystem. This doesn't actually have to do anything with the Bitcoin blockchain necessarily that went wrong. It's just these companies
But it does.
You believe that?
I mean,
well, wouldn't purists argue that like the more layers that get into it kind of gets it away from what this is supposed to be ultimately about?
Well, that's the thing when you think about companies such as Coinbase, the fact that their stock has just been annihilated, it's because you have a lot of people saying, go back to cold wallets. Why are we on these exchanges when we should be just...
Can you let Tim speak? I watched your crypto in IRL show, and you never let him speak.
Hey, the thing that I'm thinking about, though, is the wider damage that all of this does to just crypto in general. Because if you wipe out a company like FTX, which is among the largest crypto exchanges in the world, I mean, shouldn't a company like Coinbase be doing really well? But investors are just concerned that, okay, well, everybody's scared away of crypto in the wake of this. So you don't have new adoption. You have people running away saying, okay, we we watch this for 2-3 years, we're ready to throw in the towel here after something like this.
All right, well, make the fundamental case at some point for investments in this.
You're talking to Katie, right?
Well, yeah, all three of you.
What I would say is people are they're running away from these exchanges. They're going back to their cold wallets. You've got
So easy to use cold storage, right?
Cold wallets.
There you go.
Can I buy pizza with crypto? That's all I want to know. All right.
Where's your cold wallet?
In the freezer. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, and on Bloomberg Quick Take. We will see you guys beyond the bell, same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, wrapping up with our TV colleagues. Beyond the bell, our market chat on this Monday. Lots to come, including some economic points throughout the week. And of course, we're going to hear from the big bank CEOs at that Goldman Sachs conference tomorrow. In the meantime, one of the big themes of today, no doubt about it, has been China. Chinese authorities easing COVID testing requirements across major cities over the weekend as Beijing appears to be engineering a gradual shift away from its strict COVID zero policy amid elevated cases and public protests, something we talked about a lot last week. We saw the Chinese stocks in Asia and ADRs here in the U.S. rally big time last week on growing momentum around actions of an easing of the COVID zero policy, but a little bit of a different tone today, certainly in the NASDAQ Golden Dragon China Index, although individual Chinese names definitely popped in today's session.
We've also been talking on air about companies' exposure to China's COVID lockdowns, in particular, a little company called Apple. With more on that, we've got Bloomberg New Economy editorial director Eric Schatzker with us. He's in the Bloomberg Interactive Broker studio here in New York City. Before we get to Apple and China, Eric, I want to talk just bigger picture COVID and China, because I think a lot of people would keep in mind the images that we saw in the last couple of weeks of protests in China erupting as a result of strict COVID lockdown policies. How would you read into, the interpretation of quote unquote easing of COVID restrictions? Look, close to more than 3 years after the first COVID case was found.
Well, first and foremost, I'm always reluctant to advertise myself as an expert on China, but I'm fascinated by what's going on, and how can you not be, right?
Right.
Yes, it's hard to peel your eyes away from the multi-car crash that is crypto and FTX, but honestly, what's going on in China is a fascinating experiment in social control and political engineering. We always knew there would be a moment when COVID zero became untenable. It just seemed like it couldn't continue forever, and of course it can't. But who knew when the moment would come?
Right.
And how it would materialize? Turns out it was this apartment fire that killed 10 people in the far western province of Xinjiang. This is not Shanghai. This is not Beijing. This is where the Uyghurs are, right? This is an area of China that is very far away from the power centers. And yet somehow it proved to be a lightning rod and sparked protests across the country. The protests will not continue, right? Dissent is something that President Xi has made clear as recently as the Chinese Communist Party Congress that he is not willing to tolerate. But the net effect on China is that by blaming, as the central government did through its sort of communications organs, local and regional governments for being too harsh with COVID zero measures, it has given them tacit approval to relax them, which is why we're seeing things like a drop in the testing requirements to ride on public transit. And before everybody gets too excited, this is going to be gradual. In part because it remains to be seen how China is going to deal with the inevitable nationwide spike in COVID cases. COVID cases in mainland China, if the numbers are to be believed, and that for some may be an important caveat, are currently averaging 40,000 a day. This is in the midst of COVID zero. Right here in the United States, let's not forget, in January of this year, they exceeded on a daily basis 900,000. And this is a country where we actually have good vaccines.
And a country where we have a third of the population that China has.
Yes. So not only is it perfectly reasonable to expect that Chinese COVID cases will multiply many-fold from 40,000, but it's also very realistic to imagine, and it's not a happy thought, that millions of people will die from COVID in China because they aren't vaccinated with Pfizer or Moderna. They're vaccinated with Sinovac. And Sinovac, as we know, is relative to those other two formulations, a very ineffective vaccine. So once that starts to happen, you know, will the central government be as committed to easing these COVID restrictions as it seems to be today? It's a very, very delicate balancing act. China's entire social contract, you know, is sort of looming large over this process. It's really, as I said at the outset, and I'll say it again, absolutely fascinating. Transfixed me.
We're using the word conundrum a lot, and we were talking about it in regards to like Fed policy and what the Fed has to do. But I do also think, Eric, the conundrum that China saw that even as they started to ease, people were fearful of even going out there because they were worried about getting COVID. Like it's very tricky, especially as they try to ease some of these restrictions, whether or not people will be comfortable going out into society.
Sure. And we can think of that in economic terms as well,
Absolutely.
right? In principle, relaxing COVID zero should provide a boost to labor-intensive parts of the economy that have been constrained by the inability of people to travel freely and frequent lockdowns. And of course, that in turn should break the negative feedback loop that's associated with it. Weak spending by people who can't spend, hurting growth, which in turn hurts employment, which in turn hurts growth. You know, in theory, right, once people are able to move around a little more freely, those and lockdowns, in theory, end, that should be a short-term positive for the Chinese economy. But then we get into long-term considerations like what happens if companies like Apple have decided that if they're not quite done with China, they're nowhere near as committed to manufacturing in that country as they once were.
Easier said than done. We've done a lot of reporting on, and Bloomberg News has done a lot of reporting on how enmeshed China's supply chain is, or Apple's supply chain is in China. I mean, it's inextricably bound. And it's not just that that Apple relies on China for products, but they also rely on China for sales. And they've made concessions in order to actually sell products in the country, like many companies, including Tesla, have done. So how does China actually diversify its supply chain, Eric? I mean, is this a realistic thing? Apple, excuse me, thank you. How does it? I mean, is this something that realistically we can talk about?
Sure. We learned over the weekend that Apple was thinking about diversifying its supply chain out of China and moving to other countries in Southeast Asia, perhaps Vietnam and India. And the latest today, as you may have seen, is that Apple's thinking about moving. And I should add that this is not Bloomberg's reporting, but that's fine. There are lots of other good news organizations out there that Apple is thinking about moving its iPad production to, or at least part of it, to India. This is, you know, in theory doable, but to your point, very difficult. Apple has been in China for years. And there's a reason for that, right? You know, the Chinese supply chain is very well enmeshed. And it works. But Apple seems to have decided, and other countries may make the same decision, that by putting so many of its eggs in the Chinese basket just simply involves too much of a risk. Look what happened at iPhone City, right? Yeah. This is the manufacturing complex that Foxconn is a Taiwanese company, but it runs these enormous facilities in China. iPhone City employs 300,000 people. That's the size of Orlando.
It's massive.
300,000 people.
Off the charts.
It's incredible. And that in and of itself, you know, makes you wonder, like when we talk about COVID zero being untenable, is it really tenable long-term for companies to run manufacturing operations of that size? Can you imagine the logistics involved?
But also, can you imagine, and we're running out of time, but Tim Cook, this is what he does, right? Managing supply chains.
Oh, that's his expertise.
But to create that kind of exposure for your company, to have basically all your eggs in one basket is pretty amazing.
Well,
just got about 15
now,
seconds.
in the interim, the other risk he has to manage is the possibility that telegraphing these things creates a very difficult position for Apple inside China.
Really, really tricky. Eric Schatzker, this is one of the most important stories, I think, when we think about the world and geopolitical and just geo overall. Eric Schatzker, thank you so much. Editorial Director of Bloomberg New Economy in the studio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pelletier, developing story as the Federal Trade Commission says it is probing several crypto firms over allegations their ads were deceptive or misleading. The Consumer Protection Agency enforces laws that require truth in advertising, including rules that individuals disclose when they have been paid for endorsements or reviews. The agency used these rules to crack down on celebrity endorsements in the crypto space, most notably with a recent enforcement action against Kim Kardashian. Steep losses for the U.S. stock market today, with the S&P down 1.8%, down 72 points, finishing the session back below 4,000 at 3,998. The Dow was down 482, a drop today of 1.4%. Nasdaq down 221, a decline of 1.9%. 10-year yield 3.59%, with the 2-year yielding 4.40%. Gold down $29 the ounce to $17.68, a drop there of 1.6%. West Texas Intermediate crude down 3.3%, $77.34 a barrel. So stocks kicked off the week with losses. Bond yields climbed as the services gauge this morning unexpectedly rose, fueling speculation the Fed will keep its policy tight to tame stubborn inflation. So again, recapping, down day, S&P lower by 1.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this Monday. Carol Masser along with Tim Stanovic live in our Bloomberg Interactive Brokers studio. We are streaming on YouTube as well as on Bloomberg Quick Take. And we mentioned these real estate headlines earlier today about a Blackstone business agreeing to buy 6 industrial properties in the Toronto area. It was a $300 million cash deal, or almost $300 million. Again, this was industrial, this was commercial. But we wanted to talk about what's going on closer to home. And our next guest is a seller of residential space here in Manhattan. We're talking about luxury space.
Yeah, we last caught up with her back in April. And back with us right now in the Bloomberg Interactive Brokers studio is Barbara Fox. She's president of the Fox Residential Group. It's a small boutique brokerage firm that specializes in the sale of upscale residential properties here in Manhattan. She joins us right now in the studio. Barbara, how are you?
I'm well, thank you.
Well, it's good to have you back with us. If we think back to April, it was quite a different market than we're seeing right now. And look, seasonality notwithstanding, we knew things slowed down a little bit around the holidays. We've seen interest rates just surge. Then again, a lot of the people you deal with don't necessarily care about interest rates because they're not taking out mortgages. What's your assessment of the real estate market here in the city?
Well, the one interesting thing about the market is that it will always change. It actually changed from last week to this week a little. It had been very slow over the past 2 quarters.
Right.
After the first quarter of 2022, which had been very similar to the year before, which was quite good. But since then, it's been really on a downtrend, and particularly regarding all of the things that are happening in the world and the war in Ukraine and interest rates going up. And
what impacts the high-end market the most? Is it geopolitical? Is it interest rates? What is it?
I think it's just the general economic condition more than anything, and all of these things go into play with regard to that.
So the level of activity you're seeing right now is more than you were saying?
Well, all of a sudden it started to pick back up, and this is very unusual for this time of year. This is the holiday season, and people don't think about real estate, but they are thinking about it now. So I believe what's happening is that a lot of the people who need to buy and have been holding off because there's like this is a glitch here between buyers and sellers. Buyers know that the market should be more favorable to them, and sellers haven't really gotten it yet. So that's what sort of happened in the market.
So have sellers started to get it now?
I think sellers may be starting to get it, but they haven't gotten it yet.
Here's what's tricky about this market is that we're in an environment where, and look, Bank of America CEO Brian Moynihan said this a few months ago in an interview with Bloomberg, that there's so many people in the U.S. who have interest rates under 4%, even under 3%, that people who would traditionally move are willing to stay in their apartments because they don't want to go somewhere and then pay a higher interest rate.
Yeah, well, that's very true. I mean, it makes sense.
So how do you reconcile that with changing demographics, younger people who do want to buy their first home, and not necessarily having that supply available?
The only way to really justify it is to make prices comparable to the interest rate increases. And, you know, when prices are lower, people like to be able to get a good buy, and if they get a good buy, then they can make it up on the interest rate being higher doesn't really matter to them so much as long as the price is lower.
So Barbara, you know, I go to your website and I get lost. I go down a rabbit hole because I love real estate and just checking it out. But there's, you know, it runs the gamut. What are the typical properties that are moving right now? Give us an idea of price range. Who's buying? Is it cash deals? What is it?
Well, there are a lot of cash deals. I deal with a lot of cash deals, but I also deal with a lot of mortgage people that need mortgages also. But the what's really selling now is, let me start with what's not selling.
Okay, fair enough.
All right. What's not selling are apartments that need work or properties that need work. Renovation is very expensive now. It's slower than it ever was in terms of the supply chain issues. And it's just, it's a more difficult process right now. And co-ops in particular, which makes up a large percentage of our real estate stock, co-ops have to get approvals, and the co-op boards govern how many days you can work, and they make life difficult.
So will you maybe say if somebody comes with a listing and the kitchen needs to be redone in the bathrooms, you're like, I don't want to even take it?
A lot of people do that. I mean, I work with people every day that want something that's that they can move into. They don't want to have to take.
You as someone who's a seller, will you say I don't want to take those properties as much?
Oh no. Okay. Because we have ways of making things look beautiful. I mean, we take properties that need work and we have them staged and painted and cleaned, and they end up looking gorgeous. And when it comes down to what's needed, really less is needed than the buyers would have otherwise thought.
Interesting.
Yeah.
So what is go ahead, Carol.
Well, price point. What kind of price point's really selling right now?
My main price point is sort of $2 to $5 million.
$2 to $5 million.
Yeah. I mean, we do more. We do a lot higher and a lot less, but that's the bulk of our market.
There is a listing for $250 million on your website.
There is?
Yeah, that I saw.
I think there's a listing, that's a long story, but a lot of listings are on our website. They're not our listings specifically,
okay.
Just the beginning of it is our list.
Who's buying? Like, who's your typical, is it a Wall Street person? Is it foreign buyers? Who is it that's buying?
It's not as many foreign buyers as we've seen in the past, for sure. It's New Yorkers moving. It's downscaling, upscaling, family changes, people moving from one part of the country to another. A lot of pied-à-terre buyers are around now.
But people still want to be in New York, because this is something, the conversation that was going on in the pandemic, as we saw people just leave for either their homes in the Hamptons or their homes in the Berkshires or their homes in the Caribbean or upstate or the suburbs. People, you're seeing the demand. Is it back? Is it 2019 levels? What is it?
Nothing surfaces right now from the COVID period. It's like everybody wants to forget that.
Yeah.
And they're back in New York, and they may not be back as permanently as they were before COVID. They may be spending more time at their other homes or whatever they're doing. And but basically, people want to be in New York. New York is addictive. It really is.
So to your point, Carol, I'm wondering, as the economy softens a little bit, we're starting to see employers gain the upper hand when it comes to employees. For the last couple of years, the employees have really been in charge. It's been really fascinating to see. We're seeing some companies say, okay, well, 3 days a week, let's talk 4 days a week, you need to be back in the office. Do you see some sort of great migration happening back to the city from the suburbs, or do you still see people commuting who left the city during COVID?
I see people back in the city, and I think people are back in their offices for the most part now. I mean, I was talking to some lawyers, different lawyers at different firms, and they're all back in the office again.
What's the hottest part of New York City? Is it East Side? Is it downtown? Is there a part?
You can say Brooklyn. I live in Brooklyn.
Is there an area?
Brooklyn's hot.
Yes.
You know what? Every neighborhood in New York has its fans and has its devotees, and I don't think there's a bad neighborhood in the city that we deal with. I really don't. I mean, everything is good now.
There's nothing negative that you get a little nervous? I mean, we talk a lot about recession. Just got about 30 seconds left here. Any signs of that things could be even slower or slow down in 2023?
Well, there's always that possibility, but I certainly hope not. And I think as long as sellers are realistic about, if they get a live buyer on the hook, they should act and not hold out for the highest price. And I think that buyers should not hold out for the lowest price, because there's no bottom to the market. They will never find it. They will never be able to seize that opportunity.
Sounds like somebody who wants to make a deal. I'm just going to say. Barbara Fox, really good to get a feel of this, because this is certainly something we talk about a lot. What?
Yeah, I've loved talking real estate here. And you said Brooklyn, even though you specialize in Manhattan, which I love. Really appreciate you taking the time and joining us, Barbara, president at Fox Residential Group. Bloomberg Business Week is brought to you by the Donors Fund. It's a modern, innovative, donor-advised fund for everyone. Open a free account in minutes with no minimums, no transaction fees, or hidden costs. Visit thedonorsfund.org today and get your 2022 tax deduction.
All right, back to World of National News. Back to Nancy Lyons. She's in D.C. Hey, Nance.
Thanks, Carol. The Supreme Court's conservative majority is sounding sympathetic to a Christian graphic artist from Colorado who objects to designing wedding websites for gay couples. Columbia University law professor Catherine Franke explains the arguments the justices heard today.
The website owner, they feel very clearly that the publication of a wedding-based website amounts to a kind of artistic or creative enterprise that gets First Amendment free speech or expression protections. Whereas the state of Colorado and the Justice Department feel pretty clearly that the speech interests that are at stake here are quite thin or weak as compared with the state's compelling interest in prohibiting discrimination.
Columbia law professor Catherine Franke spoke on Bloomberg's Balance of Power. Georgia's closely watched Senate race is in its final stages. Recent polling shows Democratic Senator Raphael Warnock has a narrow lead over Republican challenger Herschel Walker ahead of tomorrow's runoff. Warnock is urging his supporters to show up.
Let's get this thing done one more time. God bless you, Athens, Georgia.
Herschel Walker is also sounding confident.
He's going to be former senator because it's time for him to go. And I'm going to tell you right now, don't let that door hit you in the right side as you walk out of the people's office. That's what we need to get to.
Early voting wrapped up in Georgia over the weekend with more than 2 million votes already in. One of the original human stars of Sesame Street has died. Bob McGrath was 90.
Well, now, who are the people in your neighborhood?
McGrath's family says he passed away peacefully at home. He'd been a member of the Sesame Street family for 50 years. At the World Cup, Croatia advances with a win over Japan. Brazil beat South Korea. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We begin with a developing story, a headline from the Bloomberg Professional Service. PepsiCo said to be laying off hundreds of workers in headquarters roles. This, according to the Wall Street Journal. The Journal says it's another sign that corporate belt-tightening is moving beyond technology and media. Stocks kicked off the week with losses. Bond yields climbed as that services gauge this morning unexpectedly rose, fueling speculation the Fed will keep its policy tight to tame stubborn inflation. Rit Pitcairn is Chief Investment Officer at Pitcairn Family Office, and he was our guest right here on Bloomberg Business Week.
I think the Fed has a preference for, controlling inflation by whatever means they have to get that under control. And if that means a recession, in their minds, they would hope it would be shallow and short. Detractors of the Fed would say they're actually tightening into this slowing economy, and it's going to be much deeper and longer than they think.
S&P today down 72, a drop of 1.8%. The Dow down 482, drop there of 1.4%. NASDAQ was down 221, a decline of 1.9%. 10-year yield 3.58%. The 2-year yield 4.39%. Gold 17.68 the ounce, lower today by 1.6%. West Texas Intermediate crude down 3.2%, 77.39 a barrel. Briefly, Apple retail employees are pushing back on unionization efforts at a location in St. Louis. Staffers there saying they do not want to be represented by the International Association of Machinists. Apple shares down today by 0.8%. And that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this Monday. Charlie mentioned PepsiCo. I just want to do a quick check on the share. PepsiCo laying off workers at the headquarters of its North American snacks and beverage divisions, a signal that corporate belt tightening is extending beyond tech and media. This is according to people familiar with the matter and based on documents reviewed by the Wall Street Journal. So this is coming from Dow Jones. Shares of PepsiCo, by the way, they are pretty much flat here in the after hours.
On the Bloomberg, I'm looking at PepsiCo. They have more than 300,000 employees, Carol. So, but important to read into this in the context of it happening at the headquarters.
Yeah, absolutely. Company will next report on February 10th, so we've got a ways to go before we get a business update. All right, in the meantime, we're going to get an update on what the heck are all of us wearing as we head back to the office as I sit here in my jeans. Are you in jeans?
I am in jeans.
You're in jeans. So let's get to it with the founder of the Southern California-inspired activewear brand. We're talking about Fiore.
Joe Kudla is back with us. He joins us via Zoom from New York City. Joe, good to have you back with us. Last time we spoke was before we started the holiday season. So just want to get a read on what things are looking like in real time from you and what you're seeing when it comes to Black Friday, Cyber Monday, and ahead of the holiday season. Give us the instant read here.
Yeah, going in, we were cautiously optimistic. We've seen great trends in our business this year. However, with all the discussion around promotion and, the inventory glut that existed at retail, we were a little worried. Fiore is a full-price brand, and we intended to stay full price through the holiday with minimizing promotions. But we've been really happy with performance. We came out and we exceeded our kind of best case forecast for Black Friday that carried through Cyber Monday, and it's both online and in our stores. So, we've been very happy with performance thus far.
All right, so happy, but drill down for us. So Black Friday, Cyber Monday, better than what you saw back in 2019, pre-pandemic?
Absolutely. It's a little bit different this year. Last year, we saw holiday shopping start earlier. As early as October, as the message was, there's supply chain challenges, logistical infrastructure was going to be stressed, so get your holiday shopping done earlier. And that message really resonated. So we saw the trends start earlier. This year was a return to kind of pre-pandemic kind of seasonality in terms of holiday shopping cadence. So it really did start, with that Black Friday weekend, all things materially considered. But once it started, it has really come on strong. I mean, we're seeing data from the National Retail Federation that they're seeing, really great growth. Adobe reported, as well as Shopify reported great sales, and we're seeing the same thing here at Vuori. It's been a really encouraging holiday thus far.
What about discounting? You mentioned that you're a full-price brand. Have you discounted anything, or did you have to discount anything in terms of what you see in inventory? We've heard a lot about companies that have excess inventory right now. What's your status?
Yeah, we definitely have a higher level of inventory than we've been sitting on in years past. However, all things considered, we're in a really healthy place. And so we have maintained a full price business. Sure, we have a sale page on our website where we move a couple of things at the end of a season to that page. But as far as holiday promotions, we have stayed full price. We've offered a gift with purchase for customers who spend over a certain threshold, which has been received really well. But that's always been our mantra, is to stay full price, and that's what we did this year as well.
You're, direct to consumer. You're also in retail. Where's the bulk of it, Joe, coming from? Just remind us. Is it basically online or no?
Yeah, it's predominantly online. We launched as a D2C brand, although we've opened 13 stores this year. So we're going to end the year just shy of 30 stores around the country and one abroad in London.
One of the stores you recently opened is here in New York City. How's it doing?
It's off to an incredible start.
Give us some numbers.
I wish I could share, but it's exceeding all of our expectations. We came into New York knowing we had a strong e-com customer there, but it's emerged as one of our top 3 stores in the country, and exceeding all of our expectations. So we're very happy with New York.
So give us an idea, right? Because I know when I was home, Joe, our audience has heard it a million times, is living in my yoga pants and my jeans and really comfy clothes. I'm wearing some of that back to the office, but I do dress up occasionally. How much of the active wear demand that we saw during the pandemic is staying?
Yeah, there's a shift in consumer preferences without question. So at the beginning of the pandemic, wardrobes shifted to joggers and sweatpants. We make an incredible fabric called Dream Knit that we're famous for, and that was a really big business for us. We feel very fortunate that the consumers stayed with us, but their preferences have evolved. Our fitness business has really grown exponentially this year, and our travel commute assortment, or another way of saying that would be like work leisure product. This is product that's made from those technical fabrics we're famous for, but we're designing everyday sportswear that's appropriate for the office or dressing up for an occasion. And those categories for us have really grown a lot this year. So definitely, without question, we're seeing shifts in preference. But I think what's interesting about athleisure brands, Vuori specifically, is like we didn't just change activewear, we really changed clothing in a lot of respects, because we're bringing these incredible textiles that are comfortable, they're breathable, they move with your body, and we're applying it to everyday sportswear. And so that's disrupting your more traditional sportswear brands as well.
I'm going to put you on the spot here, Joe. We oftentimes hear Vuori in comparison to a company like Lululemon or Nike, but it also makes me think of an East Coast competitor, Rhone. We had Nate Checketts on our program just a couple of weeks ago. How do you think of a competitor like Rhone? Do you see yourselves competing in the same place?
In some respects, I think Nate and I both had a similar vision in terms of our launch to focus on men's first. We saw an open space there. We felt like, the male consumer was underserved in that market. As we've, launched our businesses, we have very different aesthetics. Vuori is based on the West Coast. Nate and Rhone are based on the East Coast. And then, I would say that, we've really evolved to a dual gender brand. 50% of our business today comes from women's. It's a very strong and fast growing aspect of our business. But, we both compete in this kind of, wake that was created by Lululemon. They were the first to kind of introduce premium active in our category, and brands like Vuori have our own take. Clearly, we have a very differentiated proposition centered around our built to move in, styled for life philosophy. It's all about versatility.
Right.
I think in a lot of respects, Rhone saw a similar opportunity back when they launched.
Joe, really, really quickly, 10 seconds. Any signs in your business that a recession is coming?
No signs yet. We're cautiously optimistic for next year. We're not going to swing for the fences. We're going to lock in a growth number that we can control and make sure the level of investment's appropriate, but no signs yet.
All right. Well, happy holidays. Good to check in with you. Joe Kudla, he's the founder and CEO at Vuori, joining us via Zoom in New York City. You are listening and watching Bloomberg Business Week. Carol Masterton-Stanovic. This is Bloomberg.
And I'm Charlie Pellet with a roundup of some of the day's top business stories. We begin with reports of layoffs at PepsiCo. PepsiCo said to be laying off workers at the headquarters of its North American snacks and beverages divisions. This according to the Wall Street Journal, the journal citing people familiar with the matter and documents that it has seen. It says hundreds of jobs will be eliminated. The cuts affect the company's North American beverage business, which is based in Purchase, New York, also its North American snacks and packaged food business. Apple shares declined today. Apple was down by about 0.8%. It says retail employees have pushed back on unionization efforts at a location in St. Louis, with staffers saying they do not want to be represented by the International Association of Machinists and Aerospace Workers, a labor group that has recently attempted to organize the store. Again, Apple shares today down by 0.8%. VF Corp, the owner of Vans sneakers and the Supreme streetwear brand, fell the most in more than 2 years after cutting its forecast and announcing the retirement of Chairman and CEO Steve Rendell. Today, we saw VF Corp shares plunge by 11.7%. VF Corp, as I mentioned, moving lower today. We had Tesla shares lower as well after Bloomberg News reported the electric vehicle maker plans to lower production at its Shanghai factory. Tesla shares today down by 6.7%. 0.5%. Again, a move lower for stocks today with the S&P falling 72 points, down 1.8%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Bloomberg Business Week is brought to you by Audi. Don't let someone else drive off an Audi model you've always wanted. Visit your local tri-state Audi dealer to get behind the wheel of yours today, or visit AudiOffers.com for more information.
All right, you are listening and watching Bloomberg Business Week. Just getting ready to wrap up our broadcast. A reminder, Charlie talking about, we finished off our lows of this session, but down across the board, broad-based selling. Keep in mind, this week we have a lot of economic reports. We're going to get read on producer prices. We've also got an upcoming next week, I think, CPI report as we count down. I think we're about 14 days away. No,
we're
9
next
days.
week, yeah.
9 days away from the next FOMC meeting.
You know what we don't have this week?
What?
Fed speakers.
Yeah, well, that's because they're in a blackout.
Exactly. So we get to kind of deduce what's going to happen next week based on reporting and based on the economic data that comes.
All right, so you go home to your significant others. Here's a couple stories you might want to kick around at the dinner table. Harvard University's former fencing coach and a telecom CEO are facing a jury over charges that they corrupted the admissions process in a case with echoes of the Varsity Blues bribery scandal. I remember when this crossed. Oh my God, we were all over it.
This is different, though. This is Jack Zhouch, CEO of iTalk Global Communications, being accused of bribing coach Peter Brand to, quote, facilitate getting his two sons into Harvard by having them designated fencing recruits. Prosecutors claim that Zhao paid more than $1.5 million to Brand, both directly and by overpaying for the coach's Boston area house, paying off his car and covering some of his son's college bills.
Brand is 69, Zhao is 63. They both have claimed they've done nothing wrong and insist Zhao's sons earned admission to Harvard on their own academic and athletic merits. Zhao's lawyers also contend he has a history of being generous, lending money to friends, and say he didn't befriend the coach until after his eldest son was already admitted. All right, one other story can we just throw out there? Nike ending its endorsement deal with basketball star Kyrie Irving. A company spokesperson said after about a month after suspending its relationship with the Brooklyn Nets guard when he failed to disavow anti-Semitism.
Irving had been a Nike athlete throughout his professional career and had many signature shoes with the brand. His deal, set to end after this season, was worth $11 million a year. That's according to ESPN. Surprised it took this long. Remember, this was over a month ago that he sent out this tweet with the link to this film.
But this is where brands need to think about, the positions they take and when they're affiliated with someone. All right, folks, that's just about a wrap for the Monday edition of Bloomberg Business Week. Carol Master along with Tim Stenovic. Have a good and safe evening, and be sure to check out our Bloomberg Business Week podcast for any of the interviews that you missed.
Let's get to world and national news. Nancy Lyons is in our 99.1 studio in Washington, D.C. Hey, Nance.
Thanks, Tim. The FBI is investigating what authorities are calling a deliberate attack on two power stations in Moore County, North Carolina over the weekend. It left tens of thousands of people without electricity and forced them to deal with freezing temperatures. Duke Energy says it could take until Thursday for them to fully restore power. Moore County Sheriff Ronnie Fields.
The individual that done this, it was targeted. It wasn't random. The person that done this or the persons knew exactly what they were doing.
Fields says they're looking into whether the attack had anything to do with the drag show nearby. Ukrainian officials say Russian forces launched a new wave of missile attacks against the country today. Explosions were reported in several parts of the country, and power was cut off to areas in the north. At least 3 people were killed in the attacks. The European Union and the Group of 7 today began imposing their cap on Russian oil prices at $60 a barrel. The Kremlin is working on a response and says it will not recognize the rules. The French finance minister calls the cap a worthwhile effort.
We will make an assessment of the efficiency of the oil cap at the beginning of 2023, but it's worth trying with the view of reducing the Russian revenue from oil.